Hi everyone, and welcome to episode 17 of Coffee with Cheese. I'm your host, Narciso Bomben. Before we get started this week, I did want to quickly apologize for not being able to put out a video last week. Some exciting times in our personal world. We decided to list our house, so it was quite busy around here. In fact, you may notice a bit of a difference from the backdrop. It involved a lot of staging. This office was staged as well, so I apologize for that. But you know what, it got me thinking about real estate as an investment class and some other important ways to diversify your net worth and to grow it, right? So last week I talked about, or 2 weeks ago I talked about protecting your wealth using life insurance. Today I wanted to talk about insurance as a form of investment. And what I mean by that is specifically permanent life insurance and specifically something referred to whole life participating or participating whole life, which I will describe throughout today's video, but also show you some interesting comparables to real estate as well as the tax-free savings account. So let's get started. So there are two forms of insurance, term as well as permanent. So permanent insurance still brings with it an important concept of a death benefit, so it's around risk management. But in the case of participating whole life insurance, as you pay your premiums, you can decide to, and actually let me take a step back, you receive what's called a dividend from the participating policy. You can decide to take that dividend, but a lot of clients I've helped have decided to use that to buy what's called paid up additions. So you take that dividend and you essentially reinvest it. So think about it like not any other type of investment. So as you do that, you build what's called a cash surrender value, or think about this as an investment side account. So a cash value that continues to grow and compound along with the death benefit. So here's where it gets interesting, right? Because not only are you paying to get a death benefit for the life that's insured, but you have this cash value built up, equity if you will, think about it as equity in a property throughout the life of the contract. So let's look at it from this standpoint. In the world of real estate, you have an asset that grows over time. Our participating whole life policy continues to grow as well. What's also interesting about this, if you think about the psychology of real estate and why people say, well, real estate never goes down. Well, the main reason for that is that you're not checking this daily like you have the ability to in an investment account. Not that I'm suggesting that you check your investment balances daily, but you don't have that ability with real estate. You don't walk into your front or up to your front door and have a ticker symbol above it saying, here's today's value of your primary residence or your rental property, right? So psychologically speaking, unless you get it assessed or you're considering a sale, you don't really know the value. You have an idea, but you're not fussing over it. Plus you're thinking about it naturally as a long-term asset. Well, participating whole life insurance works a similar way. Yes, you will get an annual statement, but at least it's not something you're looking at daily, where you will see the cash value build up. So there's also the psychology of this asset class in terms of permanent insurance that you put away and you really don't think about it until you need it, okay? Now, also, similar to real estate where you can pull equity without selling the house, you can do that in a cash value of a participating whole life policy. And it is also growing along the way tax efficiently. I should have mentioned this. If this is not your primary piece of real estate that you're talking about, if it's a rental property, well, if you sell it, you're going to pay capital gains tax. If you're collecting rental income, as you should be, you're going to be paying tax on that rental income. The cash value of a permanent whole life participating policy is growing in a tax-free manner, right? So it's almost like a TFSA on steroids, okay? Now I should also mention here that you need to talk to obviously a licensed advisor about this, but if you're a business owner or an incorporated professional, in both cases incorporated, there's some very compelling reasons to do that. I won't get into the weeds now, but you can certainly reach out to me. But if you're not incorporated or don't have a corporation, before you start looking at a strategy like this, the participating whole life, you should make sure that your RSPs, your TFSAs are maxed out. And then whatever non-registered money you're starting to build up, that's where this strategy comes into play. So I also wanted to mention that as well. So getting back to how you access this cash value during your lifetime is you would borrow against the policy, not on like taking out a secured line of credit, Maybe later on in life, individuals don't want to leave their home. They take out what's called a reverse mortgage, right? So you're not really paying for it as you access the equity, but it's lowering the value of the property because you're building up a mortgage against it. Again, this is not a session to get into what reverse mortgages are, how you specifically borrow against a policy, an insurance policy, but to say that it is there and available, and it's a tax efficient way to do so. Because the one thing I've learned quickly as a certified financial planner is that two of the big things that impact wealth over the long run are taxes and inflation. So if you can use various tools to protect against tax and inflation, it's a powerful thing that you need to be considering. Lastly, if you think about a lot of real estate empires that have been built up, and I shouldn't even use the term empire, like, so if someone's got in their corporation commercial real estate or outside a bunch of rental properties, if they're not transferred to the next generation properly, or if they're going to pass in the estate, there could be a huge, or likely will be a huge tax liability, but also a liquidity challenge around paying those taxes. It's not very easy, relatively speaking, to unload real estate to pay taxes in an estate. However, a participating whole life policy is very efficient when the life insured passes away and can fund that tax bill. So I almost describe it in some senses as a virtual piece of real estate. So if you have 10 rental properties and you manage this property over the life of your of building this empire, is what if one of those pieces of real estate turned into a virtual real estate through a life policy, and that could take care of all the taxes in your estate, right? It's another way to think of things. So in summary, what I'm trying to articulate here, insurance can be another type of investment, another asset class. It has to be for the right situation, so you need to have a proper discussion around it. But when it is a quite tax efficient, inflation protection way of building and protecting wealth for you and your family. So that's it for today's episode. I did want to thank you for your patience and not being able to put out a video last week. Again, exciting times. This is our property. If you have any questions or comments at all, feel free to leave them. And as always, feel free to reach out for a one-on-one virtual coffee with myself, and I'd be more than happy to talk to you about this in more detail or anything else on your mind. Thanks again for watching, and have a great day.